what we did the first one. I'm going to repeat it just as a reminder. Remember, whenever we have transaction, what do we do first?
Analyze it.
Analyze it. Thank you. See? Thumbs up. I don't know how to draw that. I stopped at the smiley face, which also looks weird, but this is it's clear. So here, the first thing that we need to do whenever we face a transaction, whenever we see a transaction that we need to record, we analyze it. We decide whether we are going to record it or not. And then we start analyzing what accounts are involved. Like in this one here, for example, there was an investment of $10,000 in cash in return for stocks. So as a result, we know that cash was affected, common stock was also affected. What happened to cash? Cash has increased. What happened to common stock has also increased. So we debit. We know that assets, when assets increase, we debit them. And at the same time, when common stock increases, we credit the account. So we debit cash and we credit common stock, right? And then last part will be posting. This is where we post it to each account. The accounts that were involved in this case were cash and common stock. So we put on the left side of cash, on the debit side of cash, we put $10,000, and on the credit side of common stock, we put $10,000. Any questions? Okay, so we did this one as well. And if you remember, we had to say that we had to keep in mind at all times the accounting equation must hold. So assets must equal liabilities and stockholders' equity. At the same time, we also have total credits and total debits must also be equal. Okay? So let's continue. This is where we stopped. So Pioneer receives a $1,200 cash advance from Arnott's, a client. So they received cash in advance for advertising services that they will be performing in the future, not now. What are the accounts that are involved? Again, we have to analyze the transaction. What happened here? They received cash in return for services that will be provided in the future. So, what are the accounts that were involved? Cash and?
Liabilities?
Yes. So cash and liabilities. Specifically, which liability? Yeah. Not accounts payable. Accounts payable, this is something that the company expects to pay. The company does not expect to pay. The company receives the money in return for a service that they will be provided. Now, if they had received a service, on the other hand, and they didn't pay, that will be accounts payable. But here they are not receiving a service, they are providing a service. So it is unearned revenue. This is a little bit confusing. So unearned revenue is what? This is money that the company receives before selling a product or before providing a service. They received it in advance. Did they earn the money? When do they earn the money? They will earn the payment when they actually perform the service. They did not do that. As a result, it's still an unearned revenue. So this will become a revenue once the service is provided. But so far, it's still unearned. So we call it unearned revenue. And why is it a liability? Because now the company, because they accepted the cash, because they took the cash, now they owe their clients a service. They don't owe them money. They didn't take a loan from them. They owe them a service. It's like, for example, if you pay, if Rutgers pays Dell for 100 computers to be delivered in 6 months, bless you, to be delivered in 6 months. Dell doesn't owe Rutgers any cash. They owe them what? Computers. So the computers are the debt at that point. Do you understand the concept here? Why unearned revenues Because a lot of people think that unearned revenues are revenues. Because you haven't earned them yet. The company owes their client, in this case, the company owes their client a service that they have to provide. So the service itself becomes the debt. As a result, we have unearned service revenue and cash. Cash has increased. The company received cash, $1,200. Cash will increase by $1,200 because they owe this because they owe this to their client. It will go to unearned service revenue as also an increase of $1,200. Now we go to Now we go to debit and credit analysis. So we analyze the transaction. We know which accounts were affected and in which way. Cash increased. So what do? We debit cash. So we debit cash and liabilities increase. We credit liabilities. Do you remember that, or do you want me to just go over that slide that reminds us of all the debits and credits? Sit quickly by show of hands. Do you want me to show you that slide again? Okay. So this is the one that actually shows us all the accounts. Do you remember? Assets, when they increase, we debit them, right? And when they decrease, we credit them, and vice versa. So you can also say that when we credit them, that indicates a decrease in cash. When we debit cash, or assets in general, so when you debit assets, that indicates an increase in that asset. Okay? Liabilities is the other way around. So we have with the credit, it means it's an increase, and with the debit, it's I'm waiting. I'm patient, I guess. So with the debit, it's a decrease. With the credit, it's an increase. What about common stock? Same thing. Retained earnings and revenues, they are all the same thing. Revenues and dividends, if you remember. No, expenses and dividends, if you remember, because they decrease. So an increase in dividend will decrease stockholders' equity. The effect will be the opposite. As a result, a credit to expenses will decrease it. A debit to expenses will indicate an increase in expenses. You guys remember that, or you have an issue with that? Just remember that if we do that, if we bring dividends and expenses to the other side of the equation, we'll have everything in positive. Then you will have assets, dividends, and expenses will increase with debit, decrease with credit, and then we have liabilities, common stock, retained earnings, and revenues, and we credit them when they increase, we debit them when they decrease. Okay? So the journal entry will be, as usual, remember, we have October 2nd, we have the date, then we put first the debit account, so we debit cash, 1,200, and then next we put the credit account, or the account that was credited, which is, in this case, unearned service revenue. Okay, underneath it, you put the explanation. You have to remember this. Then we post it to cash. And basically to the ledger accounts, you post it to cash and unearned service revenue. Any questions? Okay. Next, on October 3rd, Pioneer pays off rent for October in cash, $900. Again, accounting equation, we have to do the analysis of the transaction. So what's the transaction's analysis? Yes. So we have cash and rent expense, right? They paid in cash. What happened to cash?
Increase.
Decrease. What happened to expenses? Increase. So far we know that, oops, that was, too late. So cash decreased by 900 and expenses also decreased by 900. Remember, the minus, when you do that, the minus indicates the negative effect on all those equity, okay? Think of it this way, always, if you get mixed up. So you have the two sides of the equation are still equal. Cash has decreased, so we credit cash. Expenses, we have increased, right? So we debit expenses. We have an increase in expenses, 900. So the journal entry will be what? So we have, on October 3rd, we debited rent expense, 900, and then, remember you have to put this indentation, a little bit to the right, you have the right side of the equation, which is the right side of this event, which is in this case cash, a credit to cash for $900. Then we have to post it to the account, right? So in this case, if you want to calculate at this point the balance in cash, what's the balance in cash? So the way to calculate the balance for any account, you get the total debits and the total credits for that account, and you subtract them from each other. So in this case, cash is an account that usually has a normal debit balance, right? As a result, you do total debits minus total credits. In this case, it is 10,000 plus 1,200, that's 11,200. Minus 900 will be, so you will have it like this. So in this case, the way we do it, you have cash, have October 1, we have 10,000, 1,200 on October 2nd, and October 3rd, company paid 900. So the balance here would be equal to 10,000 plus 1,200 minus 900, right? This is how we calculate it for all the accounts. In this case, for example, rent expense, because there was only one entry, that would be equal to, the balance is a debit, it's on the debit side of 900. Okay? So on October 4th, Pioneer pays $600 for a 1-year insurance policy that will expire next year on September 30th. This is the opposite story. This is the opposite of unearned revenue. The company paid something in advance, but are they going to use it now or are they going to use it in the future? In the future, right? Did they use, at this point, did they actually use the insurance policy? No. So what are the accounts that are involved here? Cash. Well, we know that there's cash and there's what we call prepaid expense. In this case, it's a prepaid insurance expense. You see, unearned revenue is not revenue yet. Prepaid expense is an expense that has not occurred yet. So it's not an actual expense. What do you consider this to be? This is an asset. You see, the idea here is that now you pay for an insurance. You purchase an insurance policy. This insurance policy will be used in your business, right? So this insurance policy by itself becomes a resource. And assets are what? They are resources. So this policy that you purchase in advance becomes a policy, becomes an asset that you will be using in the future. So we treat it as what? As an asset. Later on we will learn how we will adjust for that asset every month. Why? Because the insurance will expire every month, it will expire by 1 month. Okay? But for now, this is what we know. At the time of purchase of this policy, for $600, the company paid in cash. So what happened to cash? Cash has decreased by 600. prepaid insurance expense, what happened to it? It has increased by 600, right? Both of them are assets, so the net effect on the accounting equation is 0. We have an increase in one asset, a decrease in the other. Okay, so we have one asset that will be debited, one asset that will be credited. We will debit. In order to increase, we know that we have prepaid insurance has increased. So what do you do when an asset increases? We debit. So we debit the increase. So we debit that amount to prepaid insurance, and we credit cash. Okay? Again, later on, after that, once we finish with the journal entry, we post it to the ledger. Any questions so far? Okay. By the way, I'm going a little bit fast because I'm trying to have more time to solve some problems and to solve those couple of problems, or at least to give you an idea of those problems. On October 5th, Pioneer purchases an estimated 3-month supply of advertising material on account from Air Supply for $2,500. Did the company pay? The company did not pay. Whenever the company does not pay, what does it automatically mean? That's a liability, right? The company took a new loan, and what's the account that we use? Accounts payable. Okay? When they say on account, it's account payable. If they are providing services and they don't receive cash, instead of receiving cash, they perform services on account, that will be accounts receivable. In this case, it's accounts payable. And the other account is? Yes? The asset. Which asset? Supplies. So we know that supplies have increased by $2,500, and the liability accounts payable also increased by $2,500. Once again, we have the two sides of the equation. The change to the two sides of the equation is the same, which is to mean the total for each side of the equation is correct, is the same. Now, debit and credit analysis. The asset supplies increase. So what do? We debit supplies, we credit accounts payable. A liability, when it increases, we credit that liability. Once again, as you can see, we always have debit equals to credit for every transaction. Okay? And then we post it to the accounts, to each account. On October 9th, Pioneer hires 4 employees to begin work on October. Each employee is to receive a weekly salary of $500, etc. Now this is a transaction that we do not need to record it. Why is that? This is hiring the employees. The company did not pay them anything yet. They have not started work. Okay, they will start working next month. As a result, nothing will happen. None of the accounts the company has, they didn't pay them in cash. They don't owe them any money. As a result, this is a transaction that is not expressed in monetary units, right? This is not expressed in dollars. You see all those numbers? Those will be for the future when they start working. For now, they haven't started working. They haven't started to work for the company. As a result, this transaction does not get recorded. On October 20, Pioneer's board of directors declares and pays a $500 cash dividends to stockholders. What happens in this transaction? Come on, someone from the back. Yes? Step by step. We have to do it step by step so that we don't get mixed up, at least at this point, until you are very, very proficient at this. Until you know it, you know how to do it without any mistakes. Try not to skip any steps. It takes you like 2 seconds, 2 or 5 more seconds, but you'll know for sure that it's not, you won't basically write it, get this basically confused or anything like that. So let's do it one by one. So what's the first step? Basic analysis. So what's the basic analysis? They declared and they paid cash dividends. So what happens to cash? Exactly. So cash decreased by 500 and dividends increased by 500. Do it step by step. And the next step would be to analyze it from a debit credit perspective. In this case, we know that cash will be credited, dividends will be debited. Any questions? So the journal entry will be a debit to dividends and a credit to cash. Once again, we post it to the accounts. Any questions? In the equation, you put it as minus 500. Remember that this simply means that it has a negative effect on stockholders' equity. It will decrease this side. Dividends themselves, they have increased. The minus here simply indicates that the side of the equation has decreased by 5. Any questions? Okay, on October 26th, Pioneer owes employees salaries of $4,000 and pays them in cash. So the company pays cash. So basically here you're you're talking about, you're not sure whether this is, you know that cash has decreased, right? When did they start work? No. So when the company actually pays that amount, what will happen? They are paying for the expense. This is salaries and wages expense, right? You see, because it's within the same accounting period, you recognize it as an expense. If it were in the next accounting period, we'll learn about that later on, it becomes salaries and wages payable. That time, they will owe them certain. So let me give you an example. Let's say that now I'm working here and I'm supposed to get my check in 2 weeks. Okay? We're still in September. Yes. So for the work that I will be doing in September, I will get paid for that amount in September. Let's say September 20th. So until September 20th, the 2 weeks before that, I will get paid for that now. The next check is supposed to come in October, say October 4th or something like that. Now, because it's going to be in the next month, the company will have to make some adjustments. By the end of the month, they're not going to send me the check. But by the end of the month, they will have to recognize their debts. I don't want to get too much into detail about this topic at this point because we will cover that in a lot of detail in the future. So for now, here what we're saying is that the company pays their employees for their work in for their work in October, for those 2 weeks. They pay them in cash. So at this point, cash will decrease, of course, and the expense, salaries and wages expense, will increase by 4,000. Okay? Now, debit and credit analysis. Cash decrease, so we know that we are going to credit. And we have expenses that have increased, we debit them. As you can see, there's some kind of like a pattern here. And it's easy. Think about it again, and basically in how each account is affected. Cash is going to decrease. Cash is decreasing. So what happens when cash decreases? We credit it. What happens when an expense increases? We debit. As simple as that. So it doesn't matter whether this was rent or rent expense, or whether this was fee or something like that. Anything that is an expense and it increases, the company will debit that account. And the journal entry here is going to be debit to salaries and wages expense, credit to cash. After that, we post them. On October 31st, Pioneer receives $10,000 in cash from Coca Company for advertising services performed in October. So they perform those services. Now, because they perform the services, what does that mean? Yes. It's service revenue. So because the company has already provided that service, they are done with it, they completed that service, it will be a service revenue. They recognize it as revenue because they earned it. So this is an earned revenue. We don't say earned revenue, but the company earned this service revenue. Did they receive money in cash or was it on account? Cash. So we know that cash will increase by 10,000 and revenue will also increase by 10,000, right? When cash increases, what do? We debit cash 10,000 and we credit service revenue 10,000 to indicate that service revenue has also increased. The journal entry, again remember the date, then you have debit account, credit account, and the amounts, basically according to each, the amounts that correspond to each one of them. And underneath that, you have the explanation. Any questions? Last step would be to post them to the accounts. Any questions? Okay, so here Kate Brown recorded the following transactions in the general journal during the month of March. Post these entries to the cash account. So basically the beginning balance, see this one indicates the beginning balance, which was the ending balance from the previous month. So the beginning balance was 600. Next, what do we have? That's easy. Just look at the journal entry, and you can say that this in the first one, March 4th, debit cash for 2,280. So March 4th, we have the debt, and we put it on the debit side, and then we have salaries and wages expense paid in cash, and utilities expense also paid in cash. So March 15, and you always put them in chronological order. On the other side now, it will go to, this is a credit, and this is a credit. So we'll put on the left side, on the right side here, we put 315, and we'll put the credit amount 400. And then underneath that we put, again, March 19, we have the credit to cash for $92. Once this is done, we calculate the balance. Again, this balance is equal to total debits minus total credits. Now this balance here, automatically, this 2,388 automatically becomes the new balance when you start the new month. So let's say if we're going to do the month of April, we will start with it like this, cash, and then we have April 1st. Okay, that's correct. April 1st, it will be 2,388. That's how it will be. And then you enter those transactions for that month. Okay? Now this is how the journal looks like. Basically what you have is a list of all the transactions that we just did, of all the journal entries that we just made, you have them in chronological order, one after the other, in the same order they actually happened. Here we're talking about transactions, not individual accounts. So here we're talking about, for example, the first one was the investment. The second one was the purchase of equipment, etc., until you get to the end. Okay? On the other hand, you have the general ledger. This is where you have, in one place, all the accounts that were used. We used cash, we used supplies, we paid insurance, etc. And as you can see, they appear in the order of their numbers and on the chart of accounts. So you put them in the correct order. And here, we haven't used the T accounts because it's easier, especially when you're looking at it, it's easier to look at it in a tabular form. We have more or less like a small table for each account. Remember what we discussed that last time. Do you remember that form? It's what we have here. We have the date. The explanation most of the time is empty. It's left empty because you can always find it back in the journal, so there is no need to repeat it or to be redundant. This is the reference to the journal page. Then we have 3 amounts, 3 columns for 3 amounts. We have the debit column, the credit column, and the balance, which is calculated after every transaction. So after every entry, you recalculate the balance. So you can say immediately that on, for example, October 20th, the balance was 9,200 in our cash account. And as you can see, they are usually presented in this order. First, you have assets, then you have liabilities, you have stockholders' equity, and stockholders' equity is presented in this order as well. You have common stock, dividends. And then you have the revenues and expenses. So if we start first with balance sheet accounts, and then on the ledger, if you remember, we talked about that last time, balance sheet accounts, and then we have the income statement accounts. Any questions? Bless you. So after that, companies would prepare a trial balance. Now, trial balance, this is where they simply list all the accounts that we had, the balances of all the accounts as they appear in the ledger. So as you can see here, we have cash, supplies, prepaid insurance. We have the same thing. You have cash, supplies, prepaid insurance. And then you use the balance here for each one of them. Okay? And you know whether they are, you put them, when they are, if the balance is debit balance, you put it under the debit column. If it's credit, you put it on the credit column. This is basically used also to ensure and to verify that that total debits are equal to total credits. As you can see here, total debits equal total credits. If they are not, that means you made a mistake, and then you can go back and fix it. So let's say by mistake, instead of putting equipment under the debit, put it here under credit. The numbers will not be equal. So this would tell you that, okay, something happened here, try and fix it. We'll talk about that in a second. So how do we prepare it? First, we list the accounts and their balances. How do you use it for verification? You list the accounts and the balance of each account. Then you total the debits and the credits. Once you have the total debits and total credits, you'll see if they are equal or not. Okay? Again, if you remember, we talked about this. We said that if you have the same total debits and same total credits, it does not really mean that the balances are correct. Okay? You see, this is not a foolproof tool to verify that you made all journal entries all correct. For example, let's say that here, instead of having this supplies here as supplies, you debited that amount to equipment. What would happen? Supplies will be removed. Equipment will be 7,500. Right? At this point, total debits and total credits will be equal. But is it correct? No, it's not. So this is why it's important to verify that information. So a trial balance might balance, even when, for example, if you omit a whole journal entry. You remember each journal entry has the same amount of, have the same debits and credits, right? Debits and credits are equal for each one of them. So if you enter the same journal entry twice, trial balance will balance. If you omit one, you forget to include one completely, don't record a certain transaction at all, it might still balance. If, for example, instead of crediting accounts payable, you credit notes payable, total credits will still be equal to total debits, and at that time, the trial balance will still balance. So this is what we mean here, that in certain cases, you do not, it doesn't always show the error. You have to be careful about that. Okay? That's why there is also a need for verification after this is done. Any questions? So in this case, take 2 minutes to solve this one. Don't worry, even if you missed a question, you're not going to be, it's not that big a deal, plus it will start next week. Remember, next week we will do that. So again, here when you are asked, by the way, this is a typical question in the exam. Yeah, I forgot to say that. So this is a typical question that you might get in the exam. Where, for example, you are asked to prepare the journal entry. No, in each transaction, each event, think of it as an event. So in this case, fair, right? Okay. So in each transaction, here, for example, what happened? What was the event? The company bought some equipment. Okay, so your friend here is asking, she's asking is if we have to treat as two separate events or one. But the company bought equipment. That will be one event. The way they pay is totally different. So the way they pay, basically they pay them in two things. You see, think about accounts payable, bless you. Think about accounts payable as an IOU slip. Okay? So instead of paying all the amount, instead of paying the supplier all the amount, they paid them 13, where is it? They made this purchase all at once. It was in one event. So it will be here, they have $1,300 and $200. All of it was on account. It was one purchase. So we debit. What do we need to do? What happens to our equipment and supplies? They have increased, both of them. There are assets increased, so we debit them. Did the company pay in cash? If the company had paid in cash, we would have credited cash. In this case, the company did not pay in cash. They gave them an IOU slip, which is accounts payable. It's a liability. So we credit accounts payable. Once again, every time you have something like that, you can do it in the same way. You write here, equipment increased by 1,300, supplies increased by 200, the company did not pay in cash, so their liabilities, accounts payable, also increased by the total, which is 1,500. When a liability increases, we credit. Assets, when they increase, we debit. So we know that we have to debit equipment and supplies, and we have to credit accounts payable. Okay? Here we have the following accounts come from the ledger, and we need to prepare the trial balance. Take a minute to look at this one and see what you need to do. Are you guys ready? Yes? No? Okay. Remember whenever we want to prepare a trial balance, you simply look at the balances in the order they appear. Now, trick is look at the account numbers. So you list the accounts by their numbers. Okay? So what would the first one be? Cash. Is it under, do you put it under debit or credit? Debit. Okay? Next is what? Accounts receivable. 4,000. Next. Prepaid insurance. Quinn, right? Quinn, right? You're Quinn? Sorry, Michael. Yes. I'm sorry. I thought you. That's okay. Again, remember, we all make mistakes. Luckily, because otherwise hopefully we won't be replaced by a machine one day. Don't give any ideas to the management. I don't want to get fired, remember. Plus, I doubt that any machine will be as funny as I am, right? Next is, okay, so we did prepaid insurance, 6,000. All these are debits because those are assets. So those are debit accounts, and we'll put them under debit. Next is equipment, 88,000, again under debit. We're done with the assets. What do we do next? Liabilities, right? So we have the first one is accounts payable, 22,000. And remember, you have to put it under credit column. I didn't see notes payable. Oh, here it is. Okay, so we have notes payable and then accounts payable. See, this is one thing that's annoying. You have to be very careful when you do that. I usually, to be honest with you, I use Excel and I sort them by account number. Unfortunately, you cannot do that in the exam. But if you're doing that at home, yes, you can. It's easy to just sort them, and this is how it makes more sense, right? How many of you is used to basically using Excel? Okay, there are a lot of things. By the way, I very often I add to Blackboard an Excel file. That is not an assignment. That is for you to practice if you want. And that's additional practice. And you can, and most of the time they go over that in recitation sessions if you want to attend. By the way, how many of you attended online recitation, online one? Do you guys find it useful or not? Yes. Okay. Any one of you attended the actual like in-class recitation? You attended both. Good job. See? You get the smiley face. That's only for you. And a star. She deserves it. So, which one, I'm sorry to ask about it, but which one, I'm just trying to see which balance, like the best balance in between live recitations and online recitations. Which one was more convenient? They both were fine, okay. So next, after that, we're done with, no, we're not done. We still have salaries and wages payable, right? So remember, this salaries and wages payable is not the same as salaries and wages expense because the company has not paid them yet. They are still a liability because the company hasn't paid them yet. This is whatever work has accumulated at the end of the month before paying, before this amount is actually paid. As you can see here, it's the end of the year, it's the end of the month. Whether the end of the month or the end of the year, it depends on whether you're preparing monthly statements or yearly statements. We're done this time with liabilities. Next, what do we have? Come on. Common stock, 20,000. That goes also under credits. After that, we have dividends. Thank you. It goes under debits. You have to be very careful about that. Next, what do we have? Service revenue. We have salaries and wages expense, and we have utilities expense, and then salaries and wages expense. At the end, once you're done with entering all these, you have to include the total of the two columns. In this case, we have 158,000 on both sides. That means that we did, hopefully, a good job. At least we're not sure that we made a mistake. So if you had 157 on one side, 158 on the other, that means 100% sure that you made a mistake. Okay? Any questions? Okay, so here let's do that one by one. If a correct journal entry is posted twice, here the question is, it will not balance. Will trial balance basically have the same total credits and total debits if the same journal entry was entered twice? Yes, because you will have still at the end, say you added $500 under credits, you will also add $500 under debits. So this one is not, it will balance. So here, will balance. The purchase of supplies on account is debited to supplies, that's correct, and credited to cash. You did debit and credit the same amounts, however, they went on to a different account, right? So this one is also not correct. $100 cash drawing by the owner is debited to owners drawing for $1,000 and credited to cash for 100. There is a difference between the numbers that were debited and credited. This is why this one will not balance. 450 payment on account is debited to accounts payable for $45 and credited for $45. So in this case, you should not think about whether this is correct or not. What you're thinking about here is, will they be equal or not? You made the same mistake. So here, for example, you had 450, but you entered it as 45 on both sides. So it was supposed to be 450, you entered it as 45. So you made the same mistake on both sides. When you make the mistake on both sides, the trial balance will balance. Any questions? Yes? So which one? B. The company, so what, in this case, the company purchased supplies on account. They say that the company purchased supplies on account for $500. Okay? Just to give it a number. So what do you do to supplies? Supplies, you debit it 500, and it's supposed to be on account. So the correct one is accounts payable is credited 500. Instead of crediting accounts payable, you credited actually cash for 500. For this equation, for this journal entry, still you have total credits 500, total debits 500. So it will be 500. Will it balance? Will the trial balance? Yes, because you still have the same amount on the total on the debit side as well as the credit side. So it will balance. As a result, this is not the correct answer. Any questions? So this one, I'm not sure if I already posted it or not. Did I? Did I post it on Blackboard? Oh, those of you who added the course, please be reminded that the course is on Blackboard, not on Sakai. It's one thing. Other thing, I already posted the survey. Thank you guys. Many of you already filled it out. Again, we really appreciate that. And it's fine. Can't think of anything else to say. So in this, usually there are two sets of slides that I upload. The first, this is for the newcomers. I always upload before class a set of slides that is shorter, without all the problems, without anything that we will be solving in class, where I need you to think about it in class and answer it rather than just read the answer on your slides. And then after class, so for example, the set slide with my lovely handwriting and etc. will go on Blackboard, basically hopefully either tonight or tomorrow morning. Okay? Tomorrow, let's not say morning. I'm not an early bird. And this problem, what we will be doing is we will recreate the journal entries based on the transactions that were posted to the ledger account. In this case here, what they are asking us to do is to prepare the complete general journal from which the posting to cash. So we only want to look at cash. When you have to do that, the first thing you need to do is to look at, to start with accounts in chronological order. So April 1st, it was 10,000. Okay? You look at the other accounts and see if there was any posting on that day. What do you see? Yes? Who said that? Yes. Common stock inquiries for the same amount and the same date, right? So we know that on April 1st, what did we have? What happens to cash? Again, it's easy. You look at it here, it's on the debit side, this is on the credit side. So it was debited. So this is cash. It was debited, 10,000. And then the other account was common stock. And I'm too lazy to write the whole thing. Plus, let's not waste our time. 10,000. The explanation would be what? Issuance of stock. No, that's not what you said. This is issuance of stock, right? That was an investment. Someone said an investment. So the same thing. So this is issuance of stock. Next, which one is next? You guys have to say it. April 12, right? It was 900, and which one was it? No, April 4, true. Is it on the cash account? So it is true that April 4th we had supplies that were on account. So if you look at this one here, okay, this is too dark. It's going to be hard to see. So this one and this one, that's correct. If we were to do the whole thing, right? But in this case, they asked us specifically to do only the cash. You have to be very careful about that when you're doing your homework. Okay? Make sure that you do exactly what they're asking you to do. So we only do cash. We did this one. Next is April 12. April 12. What do we have on April 12? Cash was debited, right? 900. Let's look at something that has on April 12 that has April 12 and 900. Which one is it? Service revenue. So the company provided services. This is we have it's 900 also credit, and this was provided service or cash. Next is what? Sorry? Oh, sorry. Don't be afraid. Tell me that I need to scroll up or something like that. I do tend to forget sometimes. So next is April 15, we had a credit to cash with the amount of $720. That corresponds to what?
Salaries.
Salaries and wages expense. So we know that on April 15, we have salaries and wages expense was 720. Cash was credited 720. And the tax would be payment of salaries. Something like that. Okay, so this is how you do the whole thing. I'm going to continue, we're going to stop at this one because it's going to take time. Here they tell us to prepare trial balance. Okay? Trial balance again, we list the accounts and the number of their accounts. So we start with cash. What comes after cash? Cash, and here we have the cash balance. I'm not sure how much. Can anyone calculate it? Just give me 1 second. So it's 10,080. And cash is on the debit side. Next account will be what? Accounts receivable. The value is 2,800. Accounts receivable, 2,800. Next is supplies, 126. The balance is 1,800. So this is supplies, 1,800, etc. And then at the end you have here total debits, total credits. Any questions? Am I going too fast or is it okay? Perfect. This is another one that I wanted to show you, and this is probably, I'm almost certain that you have a problem like that in the exam and the homework. This is where you have a balance, basically a trial balance that does not really balance. So you ended up with certain numbers, and then you know that there were certain mistakes. In this case, they will ask you to prepare the correct trial balance. So cash. They said originally that it was 3,850. You start from that point and you start making corrections. Let's read here a little bit. Here, for example, you review the ledger and it reveals that certain errors. You discover certain errors. For example, the totals of debit size for prepaid insurance, accounts payable, and utilities expense, they were each understated by 100. So for each one of them, you will have to add 100. Okay? So this is how you can do it this way. So for example, this one, it's prepaid insurance, right? Did they say they prepaid insurance? You add, put plus 100. Accounts payable, also plus 100. No, actually, be careful. Here, the debit side was, for accounts payable, was understated by 100. So what do you need to do?
Minus.
Sorry? If you feel that you're getting confused, you can draw it like this. So we have accounts payable. The balance was 4,500, right? That's what's written. What did they tell you? That they omitted $100 from the debit side. Am I correct? You put it on the debit side. You recalculate the new balance. What's the new balance?
4,400.
4,400. So basically you have here minus 100. Utilities expense was also understated by 100. You can do it? Yes.
Wouldn't it be accounts payable minus 100? You put it under the 3
Oh, yes, you're right, sorry. Actually, that was 100, and it was this one here minus 100. Thank you. Now, on the other side, on the other hand, we have here utilities expense. Once again, the debit side was understated by 100, so you add 100. Now let's do cash, basically cash, and I'll tell you then later on how we can deal with that. So we started with 3,850. So for cash, we have 3,850. What do we have here? Let's look at them one by one and see which one we had cash that was affected. Transposition errors were made in accounts receivable and service revenue. Cash was not involved. A debit posting to salaries, wages, debit posting to salaries and wages expense of $200 was omitted. Okay? So you look at them one by one, because I think we're run out of time. What you do is you look at them one by one, and you see what effect it has on each account. You recreate the accounts, the trial balance based on this, in the same way here. So here you added plus 100. Let's say that you also needed to subtract 200. You put next to it, minus 200. And then at the end, you calculate it, and you have the number. Okay?